you very much, Mr. Chairman. I think there probably is broad agreement that this legislation should end bailouts, that the legislation should aim at the excesses in our economy that caused the collapse that we've seen in the mortgage industry and in the credit markets. Yet I'm concerned that it does not do that. The financial regulatory reform legislation that the conference will consider and will directly affect how small and large businesses operate. It will dramatically expand the government's involvement in the economy, restrict the availability of credit, and limit the choices available to consumers. As we know, and as our constituents experience on a daily basis, the effects of the 2008 crisis continue to wreak havoc throughout the economy in communities across this country. Access to credit, access to jobs, and in many cases, faith in the ability of Washington to do any good whatsoever all remain lacking. We should examine all of this legislation very thoroughly and take only the very best parts in order to make sure that we reform our financial markets without harming access to credit and job growth. As many of our colleagues have stated, we are not starting on a good note since we just received the base text a few hours ago. We're told that this is largely the Senate version, yet as I understand it, there are 300 new pages here that were not in the Senate version. It's hard to be sure, though, because it's not identified. There is no red-lined copy, and we are now left, and the American public is now left, to try to figure out exactly what is the new bill that we are considering. It would be very helpful if we had a red-lined copy available for this committee, for this Congress, and for the American people to see what has been negotiated and identified as the new bill over the last few nights or weeks and now presented here before us. The process suggests that much has been done without the committee's active involvement and that we are now yet again being forced to consider legislation that we do not understand and frankly which I'll bet nobody on this committee has read, at least the next 300 pages that have been added overnight. We need to have transparency and an open process if this conference is to do its job well. With regard to some of the key elements of the bill, I said at the outset, there's very little disagreement that we need to end bailouts. The taxpayers should never again be put on the hook for the bailouts like was done in the last few years as we have dealt with the credit collapse and the mortgage crisis. There is no company that is too big to fail. And although it is appropriate for us, and we should include provisions in this legislation to help make sure that we resolve these large failing companies in a way that does the least amount of damage possible to the economy, we should not create a system in which there can be ongoing involvement of the federal government without reasonable limitation to protect against this unending federal bailouts of these large institutions. And in that regard, the bill is noticeable for something as much as what is in it as for something that's not in it, namely the largest bailout in America, Fannie Mae and Freddie Mac. So far, Fannie Mae and Freddie Mac are the largest of all the bailouts we've dealt with. You take the auto industry, the financial industry, the insurance industry, the takeover of the student loan system, all that you want to take there. And if you look at the bailouts, the $145 billion that the taxpayers are already on the hook for with regard to Fannie and Freddie, which is expected by experts to over $350, $380 billion before it's done, is absolutely absent from this legislation. I offered an amendment which simply required that Fannie Mae and Freddie Mac be included as part of the federal budget as long as either institution is under conservatorship or receivership. It would also have reestablished the $200 billion cap per entity and accelerate the 10% reduction in mortgage portfolios, effectively requiring these companies to shrink those mortgage portfolios from their current levels. As you might guess, the amendment failed on the Senate floor. There still is nothing in the bill about Fannie and Freddie. All this amendment would have required is that we tell the American public what debt they are assuming because we refuse to reform Fannie Mae and Freddie Mac. According to CBO Director Douglas Elmendorf, after the U.S. government assumed control in 2008 of Fannie Mae and Freddie Mac, two federally chartered institutions that provide credit guarantees for almost half of the outstanding residential mortgages in the United States, and that number is higher today than that. And these are his words: the Congressional Budget Office concluded that the institutions had effectively become government entities whose operations should be included in the federal government budget. If we did that, the debt picture that we talk about here in Congress would be dramatically changed, but at least the American public would know what debt we have assumed on their behalf and which we refuse to deal with. I'm also concerned that the derivatives title does not adequately protect end users, the people in this country who manufacture goods, the people in this country who provide those things that our economy moves on, and who need to have a thriving, well-operating derivatives market in which to operate. We also have a massive expansion of government. It's been said by many that you should never let a good crisis go to waste, and this crisis has certainly not been allowed to go to waste. The creation of the large, new, virtually uncontrolled Consumer Protection Agency in this legislation is said to be aimed at Wall Street. Yet there are folks on Main Street in every city in America, small communities and large alike, who are worried. I see my time is gone. Mr. Chairman, I hope that we can deal with some of these issues aggressively as a committee and come forward with legislation that hits the issues that we are aiming at rather than broadly hits the rest of the American economy.